Hello, good evening Facebook. Welcome to my latest live session. This evening we're going to be talking about buy-to-let mortgages and I'm going to be explaining those to you, so by the end of this you'll know everything that you need to know. Thank you to those of you that are tuning in and those of you that continue to tune in each week. I really appreciate your love and support. Hopefully you find the content that I'm providing to you guys useful. If you do find it useful, we'd be really grateful if you can just give me a thumbs up and a little like. And I would be even more grateful if you could share this video as well. That would be fantastic. So let's jump straight into tonight's session, and that's going to be about buy-to-let mortgages. So firstly, what is a buy-to-let? So simply put, it's a property being purchased specifically for the purpose of being let out rather than for you to live in. Okay, so that's the simplest form of that. Now, why would you want to do that? Well, there could be a number of reasons why you want to do it. Typically speaking, it's to rent it out and therefore provide yourself with a surplus monthly income so you can live on to sustain a certain lifestyle, provide you with some income each month. Or it could be for long-term capital growth, something that you're going to keep and allow the house price to increase as it would do over a long period of time, and then sell off in the future and benefit from any capital that's increased during that period. So that's buy-to-lets in a nutshell. So more specifically tonight will be about buy-to-let mortgages. So I'm going to start off by explaining exactly what a buy-to-let mortgage is. So when you buy a property to let it out, you cannot use a conventional traditional residential mortgage. Okay, you need to have a specialist mortgage, and there are some key differences between a standard residential mortgage and a specific specialist buy-to-let mortgage. One of the first things is that when the lenders consider an application for a buy-to-let mortgage, they are assessing that more on the anticipated rent that could be achieved from that property, rather than looking at it from an affordability perspective as you as an individual. So very different to the way they treat them for main residence mortgages, where that's all about your own personal affordability. Buy-to-lets is very much more about, well, what rent could be achieved. Now, they do still want to know a little bit about your own personal income, because they want to understand that if there are any rental voids or the property requires some maintenance, that there is some income coming into the household to cover that. But that's not always the case. There are some lenders that will have no minimum income requirements, but they still want to know what income you're receiving each month. The majority of buy-to-let mortgages on an interest-only basis, and that provides you with an income, or like I said earlier on, you could go for more of a long-term growth strategy. So I think one of the first things you need to really think about is, well, why would you want to invest in a buy-to-let property? What's your end goal? Is it to provide you with some extra monthly income, or is it to benefit over the longer term for some capital growth? And that will determine which way you set up the repayment method on the mortgage. But like I say, quite often people will do it on an interest-only basis, provides them with a monthly income, and of course you will still over a period of time benefit from some capital growth. But on an interest only, you're only servicing the interest payments to the lender, and therefore you need to have another strategy of how you're going to repay back the mortgage itself over a set period of time, whether that be 10, 15, 20, 25 years. Most people will just be selling the property. You benefit from anything it's increased by in value, and in the meantime you've taken that income each and every month. With regards to a deposit, so on a buy-to-let property, if you are purchasing with a mortgage, typically speaking, you'll need to put in a 25% deposit of the purchase price. Now, there are some exceptions to that. We do have some lenders that will accept just a 20% deposit. Likewise, there are some lenders that want you to put in 35% deposit. The more deposit you put in, the better the interest rates and the more options you're going to have. But generally speaking, most lenders will max out at a 75% loan to value, meaning you need to put in a 25% deposit. So hopefully that gives you a bit of a summary in terms of what a buy-to-let mortgage is and how that works. Now, what I'm going to talk about now is the rates, a typical rate of a buy-to-let mortgage, and the estimated fees for a buy-to-let mortgage. So as of March 2020, before the whole mortgage market went a little bit crazy, the average rate on a buy-to-let mortgage was 3%. Okay, Now, of course, there are mortgage rates a lot lower than that. There's some mortgage rates in the 1% marks, but of course there are also mortgage rates that are in a lot higher than that, in 5%. So 3% is the average, not the lowest. What you tend to find is that you will always see a market leading rate, a ridiculously low interest rate of 1.29%, but typically with those lower rates of interest, they attract larger setup fees. So you need to take that into account when really doing your cost analysis, that, okay, the interest rate's really low, but actually when I've paid this £2,000 fee, is the overall deal as attractive? So it's always worth speaking to a professional who can do a true cost comparison for you and confirm, really looking at the deals like for like on that basis. Affordability. So we touched on this a little bit more, that buy-to-lets are more assessed on the basis of what rental can be achieved, but how much rent do they want to be achieved? You know, what's the minimum? So affordability, they use a model which is called ICR, which stands for interest cover ratio, and essentially what they're looking at is typically the rent to cover the mortgage payment by at least 125%, and sometimes up to 145%, even higher in some lenders. Each and every lender has a different ICR calculation that you would need to meet, but in a nutshell, the rent needs to cover 125% as a minimum of the monthly mortgage payment. Not only that, but they will also stress test the interest rate. So although the interest rate that you get might be 2%, when they do that ICR calculation, they will stress test the interest rates, normally anywhere between 5 and 5.5%. So essentially what they're doing here is saying, well, if interest rates were to rise in the next 5-10 years, they also want to make sure that you can that rent will cover those monthly mortgage payments, not just covering it here and now while rates are low, because you know interest rates do historically do a bit of that. So affordability wise, the rent needs to cover the mortgage payments and some, and also looking at it when it's stress tested as well. Again, a good mortgage broker will be able to confirm to you on any properties that you find what rent needs to be achieved in order to cover the mortgage payments, and then you can work out whether it's going to be a good deal for you, work out the yield on that as well. Probably a typical good yield on a rental property is going to be around about the 5% mark. Slightly harder to achieve those levels in and around the southeast because of property prices, but likewise there are some properties that get up to a 15-20% yield. It depends on how you set up the buy-to-let, and I'm going to come to the different types of setups that you have, and how some will attract more rents each month than others. But that's a little bit about the affordability for you, so hopefully that makes sense. If you're still with me and it makes sense, I've not lost too many of you, give me a quick thumbs up just to say that makes sense. If you've got any questions, then let me know. So the different types of buy-to-lets and different types of buy-to-let mortgages. So you've got a traditional buy-to-let, which assumes that the property will be let on an assured short-hold tenancy agreement. So that means a single let to a family, as an example, and that's the traditional way. But in the modern day, there's more. There's lots of different ways in which people are now living. A scheme that's becoming more and more popular is houses in multi-occupancy, also known as a HMO. Particularly popular in Oxford, which is close to us, and very popular in the likes of London, but particularly around university towns. And that's where a landlord will convert the house into individual rooms and will let it on a room-by-room basis. Okay, there's lots of rules and regulations that sit around that. You do require things like a HMO license, but they do tend to yield the highest return because you normally find that, say, on a 4-bedroom house, you might be able to let it for, let's say, £1,400 a month to one single family. Possibly you could let each and every room between £500 and £600 a month to individuals. So, you're getting another £1,000 a month on the rents for the HMO route. So that's one of the schemes that's available. Typically on that scheme, a lot of from a mortgage perspective, the interest rates are a little bit higher for HMO mortgages. And typically speaking, the lender would want you to have some sort of landlord experience. They're not too keen on first-time landlords going straight into the HMO market, because essentially there's a lot more management and a lot more complex and a lot more things that can go wrong when you've got 4 different households in one house than what it would be if you've just got one family in a household. Other types of schemes we've got is limited company. So this is where you set up a company specifically for the purpose of purchasing property. There's been some tax changes in the way that you can claim back interest rate relief over the last couple of years. So there are some tax advantages to setting up a limited company when you purchase your buy-to-lets. And if you are buying it within a limited company, you would require a limited company buy-to-let mortgage. And on that basis, again, the interest rates can be a little bit higher. The setup cost can be a little bit higher, but there are potentially some tax benefits there. I would always insist that you do get some tax advice if you are thinking of going on the limited company route. And then lastly, portfolio landlords. So this is where you own more than, typically a portfolio landlord is classified as someone that owns more than 4 properties. Each and every lender has a different definition on how many properties you have to have. Some say 4, some say 5, some say 10. But essentially, there was quite a lot of work done by the regulators to really rein in the market and sort of open it up to more people. So they kind of put a lot of caps and restrictions on the amount of properties you can have. So normally if you're buying any properties up to 4 or 5, you're fine. Once you get 4 or 5, there will be some lenders that won't allow you to have any more mortgages with them. And it might be you need to get on a more specialist mortgage route and a specific buy-to-let portfolio landlord product. Okay, so that's another scheme that there is. Good, so that is pretty much buy-to-lets in a nutshell. I know there's still quite a few of you tuning in, so hopefully that makes sense. If you've got any questions on the buy-to-let mortgages, schemes, fees, anything like that, then please let me know in the comments. I'll be happy to answer it live. I've only had one question come in this week, and the question was from Martin via Instagram, and Martin's asked, I'm a first-time buyer, can I get a buy-to-let mortgage? So the good news for you, Martin, is that you can. So not every lender will do first-time buyer, first-time landlord. They want you to have your own property that you occupy for residential main residence purposes before they'll allow you to buy a property for investment purposes. But that said, there are lots of lenders that will allow you to buy a rental property as your first home. You'll need to get some advice around the stamp duty because you do forgo some of your first-time buyer benefits. But essentially, yes, you can buy a property if you are a first-time buyer on a buy-to-let basis. Again, I'd recommend that you seek some advice from a mortgage broker because it's a bit more complex. Not every lender does it, so it's important that you go with a lender that actually does accept first-time buyers. Otherwise, you could end up getting your fingers burnt there. Good, that's pretty much it. That's all the questions. I can't see there's been any more questions that have come in from any of you guys, so I really hope you found that useful. If you have found it useful, please give it a like. Please share the post. Not only would you be sharing it with your friends who may also find that useful and may benefit from the content, but you'd also be supporting me as a small local business owner. Just a quick summary for you then. So buy-to-let mortgages. So what is a buy-to-let? Essentially, it is you simply buying a property specifically for the purpose of letting that property rather than living in it. Okay, a buy-to-let mortgage is essentially a mortgage specifically for the purpose of renting the property out. You cannot use a standard residential mortgage for a rental property, so you do need a specific buy-to-let product. And essentially the buy-to-let lenders will be assessing that mortgage on the rental coverage. So they're more keen on knowing what rent can be achieved from that property and is it enough to cover the mortgage payments and some, rather than your personal individual income like it is on a standard mortgage. The majority of buy-to-let mortgages are opted for on an interest-only basis, but you should speak to your mortgage broker about whether your strategy is to invest for income or whether it's to invest for capital growth, and that might determine whether you go on an interest-only or capital repayment basis. There's no right or wrong answer. Deposits are typically 25% of the purchase price or property value. There are some exceptions to that. There are some lenders that accept 20% deposits. Likewise, some lenders require more. In terms of your interest rates and your fees, at the time of recording, the average interest rate on a buy-to-let mortgage is 3%. There are interest rates a lot lower than that, but of course there are some higher. So 3% is the average, not the lowest. And typical fees on a market-leading interest rate for a buy-to-let, you'd be expecting setup fees somewhere to the tune of anything from £1,000 up to 1% of the amount you're borrowing potentially. Typically between £1,000 and £2,000 is often the case. Affordability is based on rental rather than personal income, which we touched on earlier. Lenders use something called the ICR, which is the interest cover ratio. And essentially they're looking at, will the rent cover the mortgage payment by up to 125%, in some instances 145%, when that interest rate is stress tested up to 5, even 5.5 times income. Okay, so they really are being quite strict in terms of the way they assess this to make sure that the rent will always cover those mortgage payments, even if interest rates were to rise in the future. There are different types of buy-to-lets. You've got HMOs, houses and multi-occupancies, where you rent the rooms individually. There are some added requirements around that. You need to have a HMO license as a landlord. Lenders don't typically like to do HMOs for first-time landlords. You need to have a little bit of experience before you can do that, but they do provide higher yields, and particularly popular in and around university towns in London. You've got limited company buy-to-lets, which essentially is when you would set up a limited company specifically for the purpose of investing in property. By doing that, the interest rates will be a little bit higher, but there are some tax benefits. I would certainly recommend that you seek some tax advice if you're thinking going down that route. And if you own more than 4 or 5 properties, then you could be classified as a portfolio landlord, in which case some slightly different rules apply to you. There's different products available, and the lenders pay a bit more of a keen attention to your total portfolio rather than just the property that they will be mortgaging. So that is buy-to-lets in a nutshell. Hopefully that makes some sense. If you've got any questions or queries at all, then please do let me know. As always, thank you for tuning in. Thank you for your support, and I will be here again next week, 7:30, and I hope to see you then. Many thanks.